Hello and welcome to Asking for a Trend. I'm Julie Hyman. For the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we'll be diving into. Another rough day for markets as new U.S. data sparked concern among investors over a slowing economy and sticky inflation. The Dow saw its worst day so far of 2025. It's lost over 1,200 points in the last 2 days. We'll dive into the rest of the day's market trends. Then a big day for crypto, but it's not all good news. We'll bring you the latest from the burgeoning sector. Plus, Berkshire Hathaway CEO Warren Buffett shares his annual letter tomorrow. We'll tell you what to expect from the Oracle of Omaha. Well, Coinbase announced Friday the Securities and Exchange Commission has agreed to drop its enforcement case against the company pending the approval of the regulator's commissioners. The agency had charged Coinbase with operating as an unregistered national securities exchange, broker, and clearing agency. Here's what SEC Commissioner Hester Peirce told Yahoo Finance earlier when asked if the SEC views digital tokens as securities or commodities.
Well, I've always had a little bit of a different approach than some of my colleagues on how we think about these things. And so what I'm hoping that we can get to is a place where we have greater clarity around how we're thinking about things in a legal framework that is workable, that is consistent with the statute, but also enables people to figure out what something is categorized as without hiring lots of lawyers and having the fear of litigation hanging over them.
Joining me now, Ryan Rasmussen, Bitwise Head of Research. Ryan, it's good to see you. So between hearing what Hester Peirce just had to say and the Coinbase, it looks like lawsuit going away, what does this mean for the industry?
Yeah, I think it's a really monumental moment for the industry that the SEC has dropped its years-long tirade against Coinbase and the lawsuit that they've been chasing after Coinbase on. And ultimately, we expected Coinbase to prevail from that lawsuit in the courts. But I think it's a huge signal to the market that the actual regulatory pivot that we've been hearing is going to happen, that it's actually happening in Washington already. So we're very excited about it. You spoke to Hester Peirce earlier. Obviously, she has a different way of viewing the market than the Gensler era SEC, and she's leading the crypto task force that will take on setting clear rules and regulations for crypto and creating a framework for crypto to finally be on a level playing field with the rest of the financial and technology industry. So we're really excited about that. And we think that we'll look back in 5, 10, 20 years at today's dismissal of the case against Coinbase as a real pivotal moment in crypto's long-term journey.
Let me ask you this, though, Ryan. I mean, does this mean we're going to see an explosion of coins? I won't use the word that people use to describe these types of coins at times. I mean, are we going to see more politician meme coins, for example? And is that a good thing for the industry?
Yeah. I mean, I hope not. I hope we don't see any more politician-based or rooted meme coins. I do think that what this means is that we'll finally see some of those use cases for crypto and some of the exciting innovations that crypto can bring to traditional industries. I think we'll finally start to see those break through. But I don't think this means that every crypto project is going to thrive now. I think competition and execution certainly still matters. But what we do know today is that we're finally on that level playing field. So we're really excited about where we go from here. I do think that we'll start to see fewer and fewer of those pump and dump type coins or those political meme coins or just other meme coins as the market starts to mature and we enter this next phase of growth of mainstream adoption and playing by the rules, if you will. And for that, I'm very excited. But I do think there's been a lot of riffraff in the crypto industry for many, many years. And part of this growth, if crypto does want to mature and enter the next phase of its life cycle, part of that growth will be leaving that in the past. And I think we're on the path to do that, but it won't be necessarily a smooth ride there.
Well, when we talk about bad actors, we got to talk about the other big headline today, which is a huge, huge hack of Ethereum in particular. $1.4 billion reportedly stolen from an exchange called Bybit. That can't be a good headline for the industry at a time when, as you say, it's trying to gain more credibility.
Yeah, that's absolutely right. So today, right on the heels of this news that the Coinbase lawsuit was going to be dismissed, we heard news of an exchange, of a centralized crypto exchange being hacked for $1.5 billion worth of Ethereum. And that is a really big deal. And I think that goes to speak to the growing pains this industry continues to experience as it moves into the next phase of its life cycle. It's one of the reasons why We need more rules and regulations around how banks, how exchanges, how other financial service providers need to protect customer assets, the different security parameters that need to be in place, et cetera. I do think we also will see more institutional grade custody-like services that exist in the traditional asset class world today for traditional assets. I think we'll start to see those bleed more into crypto. And certainly certain companies, more than others, take security and other types of service protections more serious than some of those in the past. But yeah, it's not a great look for the industry to see customer funds being stolen, particularly to this magnitude, and particularly on a day where the industry was rejoicing in this monumental moment from the Coinbase lawsuit.
I mean, I gotta say, Ryan, you don't hear about this happening at a bank, right? Or at an asset manager. You don't get these types of hacks happening. What you're seeming to suggest is that maybe, even though the industry has pushed for, as you say, more clarity and in many cases less regulation, is this an area where the industry needs more regulation?
Yeah, I think that's a really good point. It is similar to someone walking into a bank and robbing the bank for billions of dollars. And you're right, we don't see that in traditional asset classes, in traditional finance. It's one of the reasons why there's so much trust in the way things are done. And there's been very little progress on the technology front and on the innovation front in the financial industry for years past. But I do think that we're not necessarily asking for less regulation or no regulation. It's really around the clarity of regulation, of what needs to happen, and guidelines, both for how institutions should operate, how companies should operate, and around consumer protection, so that this type of activity can no longer happen in the crypto industry in the same way that it no longer happens across the traditional finance industry.
Ryan, good to see you. Thanks a lot for joining us.
Thanks, Julie.
Well, U.S. stocks closing lower, seeing a steep downturn that pushed all three major averages into the red for the week. Yahoo Finance's Jared Blikre joining us now for the trading day takeaways. Hi, Jared.
Thank you, Julie. Let's begin with seasonals. Now, we didn't necessarily foresee everything that was going to happen this week, but we did have a bias coming into the second half of February. So we're going to talk about that right now. And here's a chart from Ryan Dietrich that spelled out the month of February, had a rise, and this is just history. And we always say this doesn't have to happen, it's just a tendency, but rising into the middle of the month and then declining into the end of the month, that's February. And let me show you what's happening with the entire year. So this is my seasonality map, and there's different ways to slice and dice this, but here is green in what has happened this year, and you can see it lines up perfectly here. Doesn't mean that we have to go down into March and then rise, but it's just a tendency, and so when it happens like that, I tend to pay attention, a little bit more attention. That's it.
Yeah, and what's interesting also is that the pullback here, but even part of the gain, has happened without as much participation from the Mag 7.
Yes.
Right? We've been watching that trend as well.
Guess what? That's my second point here.
Yes, I'm taking you there.
Mag 7 on the rope. So let's take a look at the mega caps here. It wasn't the best week. This is a 4-day week, and remember, we actually had Monday off, which I don't even remember. But Apple managed to squeeze out a 40 basis point gain, 0.4%, but everything else kind of in the red. Remember Meta in that 20-day winning streak? It was down every single day this week. And if you look at the year-to-date gains, I'm going to show you, this isn't really that pretty. And remember, Berkshire Hathaway, even though it's up 5.6%, not part of the Mag 7. So you have NVIDIA, which is just, let's call that flat. And then you have Meta, which is up 16.7%. That's been carrying the water, and now you don't really have that much participation. Tesla down 16%. This was a bad day for stocks, and overall, I mean, you were talking about some of the comparisons. This is the worst day either since 12/18, that bad Fed day that you were noting, or DeepSeek, that DeepSeek Monday that we had last month. So any way you slice and dice this, we are seeing a lot of red today.
Yes,
but
we are.
it's not all red, because guess what? We have diversification. That name is Diversification. And first, I want to talk about Lee Munson. Now, this is a gentleman who we just interviewed on Stocks in Translation, and he was talking about buying the 30-year when it hit 5% earlier in the year. Let's take a listen.
I'm like long the 30-year Treasury. You know, I love it when bond gurus say things declaratively, whether it's, you know, that guy over at JP Morgan, or let's just say, you know, the Gunlacks of the world, that who would buy a 30-year Treasury? And
when it hits 5%.
Well, yeah, when it hits 5%.
That's who buys it.
And it's like, well, it's just a bunch of pension funds doing, you know, liability. It's like, okay, great. So I have a bunch of goons in little blue suits looking at actuarial tables and nobody else. I'm like, baby, this is the sandbox I want to play in because it sounds like not much competition.
All right, so we had a little bit of a reprieve from bonds this week as well as China, but there's not a lot else going on that I can point to that's necessarily green.
But we have had a lot of investors and strategists come on and talk to us and say, you have to be diversified in this environment. Michael Darda, one of the folks saying that just at the top of the show, because it's a rocky environment.
Yes, and you can make the case for bonds. A lot of people say China's uninvestable still because of the regulatory overthink, but you got to play with what we have, and we don't necessarily have a lot right now.
Yes. All right. Thanks, Jared. Appreciate it. Stick around. We got to look at the state of the housing market next on Asking for a Trend. Existing home sales numbers coming in today at 4.08 million, missing expectations. The fall on a month-over-month basis, marking the first since September. For more, we're bringing in Chen Zhao, head of economic research at Redfin. Chen, as we look at these numbers, obviously the mortgage rates are a big factor in this, affordability a big factor. How are you thinking through the sort of stumbling blocks to this loosening up in the housing market?
Hi, thanks so much for having me today. Yes, I think you're absolutely right that mortgage rates remain pretty high right now, and home prices remain pretty high, and they continue to increase. However, what we're seeing in the market right now is actually that after 2 years of a very slow loosening of the mortgage lock-in effect, we're actually seeing enough inventory pile up that what we see in the market right now looks more like a buyer's market than anything we've seen in the past 6 years. So nationally, there's about 4 months of supply on the market, which doesn't sound like a lot, but it's higher than anything that we've had in the past 6 years. And in certain markets, especially down in Florida or in Texas, you're actually seeing more than 10 months of inventory. And on top of that, what we're seeing is that homes now are selling at an average 2% discount relative to their list price. So all of that seems to point to buyers having a little bit more of an opportunity than they've had in a really long time.
So I guess then what's the problem? Is it that they don't realize that they have that opportunity, right? That they don't, that they're not cognizant because they're looking at prices that seem high to them and don't realize there's wiggle room? Is it the mortgage rates that are a stumbling block? Or is it, even if there's supply there, is it that the people who are selling maybe aren't willing to negotiate as much? What's going on there?
I think there's a few different things going on. So directionally, we're seeing that things are going in favor of buyers, for sure. However, if you are a buyer, what you're still seeing is that mortgage rates are still sitting around 7%. Today, Mortgage News Daily just reported that mortgage rates are actually at about 6.9%, which is the lowest they've been in about 2 months. But that's still pretty high in an environment when home prices are still really high and increasing. And also, you have to remember that consumers are still living with, a good deal of inflation. The Fed doesn't consider food and energy prices when they're thinking about inflation. But for an average consumer, when egg prices are really high, that really, makes people nervous about buying. And there's also, right now in the country, there's a lot of policy uncertainty. So, for example, if you're a federal government worker in DC, you might be feeling a little bit anxious about buying in this kind of environment.
Yeah, that makes sense. One other thing I know you've done a lot of research on that Apollo chief economist Torsten Slok, he sends out a daily chart, and his chart today was about the average age of home buyers. And I thought this was really fascinating that the median age right now is 56. It's up from 45 in 2021, so it's changed real quickly. And in 1981, the median age was 31 years old. So we have really seen this increase. What does that tell us, and what are the implications, not just for the housing market, but for the broader economy?
Yeah, I think this is really just reflecting how extreme unaffordability has gotten in the housing market. So we all know that during the pandemic, home prices increased a lot, about 45% over the course of 2 years. And then immediately on the heels of that, what you had is mortgage rates doubling, right? So what you're seeing now in the NAR data is, yes, the average age of home buyers seems to be increasing a lot. Redfin has looked at some data on mortgage lending, the HMDA data. And what that shows is that when you're looking at home buyers who are financing their purchase, the age of home buyers in that group has actually not increased a lot. So when you take that and you combine that with the NAR data, what that seems to suggest is that there's more buyers who are paying in all cash, and that those buyers are disproportionately older now. So what you're really seeing in the market is a market that really favors older people who are wealthier, who can bypass mortgage rates, and thereby that's just increasing inequality in the market.
Yeah, most definitely. Chen, thank you so much. Really helpful perspective here.
Thanks so much.
Berkshire Hathaway CEO Warren Buffett is due to release his eagerly awaited annual shareholder letter on Saturday morning, along with the company's fourth quarter earnings results. This year marks Buffett's 60th leading Berkshire, and the company is operating from a position of strength with record operating earnings in the first 9 months of 2024 and a near record stock price. Berkshire Hathaway is now valued at over $1 trillion, and those Class A shares have seen their price increase by 35,000-fold since Buffett took control of the company in 1965. Now, as always, shareholders will be closely scrutinizing the letter. Here's some of the topics they could be looking for. Any commentary on the broader environment, including weighing in on President Trump's proposed tariffs. Buffett was critical of past tariffs during Trump's first term. Secondly, Berkshire's cash pile. The company was sitting on about $310 billion in cash at the end of the third quarter. That's up from $167 billion at the end of 2023. And the year-end figure 2024 could approach $320 billion. That's according to CFRA's Kathy Seifert. Investors want to know why Buffett isn't seeing better opportunities to spend that cash in the market. Seifert also said investors want more information on margin pressures at Berkshire's auto insurance company Geico, including any information on losses tied to the California wildfires. And of course, with Buffett turning 95 in August, readers will be searching for any clues about succession timing. In last year's letter, Buffett wrote that his presumed successor, Vice Chairman of Non-Insurance Operations Greg Abel, is, quote, ready to be CEO tomorrow. Well, coming up, we're taking a closer look at today's consumer sentiment reading and consumer expectations for inflation. That's in our chart of the day. More asking for a trend on the other side. For our chart of the day, we're breaking down inflation expectations from today's final consumer sentiment reading. Yahoo Finance's Alexandra Canal joins me now with a closer look. Hi, Ali.
Hi, Julie. Yeah, American consumers, they had a dimming outlook on the U.S. economy as uncertainty related to Trump's trade policy lifted inflation expectations sharply higher for the second straight month. 1 year inflation expectations jumping to 4.3% in February. That's up from 3.3% last month, and it marked the highest reading since November 2023. But it wasn't just the 1 year outlook. Long run inflation expectations that tracks expectations over the next 5 to 10 years that climbed from 3.2% in January to 3.5% in February. And that's the highest reading since April 1995 and the largest month-over-month increase since May 2021. So our chart doesn't go all the way back that far, but you can see how we've been a little bit bumpy, but then continuing to track upward as these tariffs and all these policies come out of Washington. Joanne Su, she's a director of consumer surveys at the University of Michigan. She told Yahoo Finance earlier that unlike in years past, folks are not reacting to current price shocks. They're instead reacting to anticipated price shocks. So a lot of this depends on which tariff policies are ultimately rolled out and whether or not that trickles down to consumer prices. Now, we asked about this uptick in inflation expectations to Michael Darda from Roth Capital Partners, and he said it's something the Fed in particular is watching very closely. Take a listen.
The Fed is on indefinite pause now, more concerned about some recent warm inflation readings. You mentioned the University of Michigan data for February. That 5 to 7 year inflation expectation reading is at the highest level since 1995. Now, the mid-90s were not a particularly inflationary period, but I don't think the FOMC is, is flattered by the direction, which is up and to the right. It's not what they want to see.
And to that point, earlier this week, we had Fed meeting minutes released for the meeting that we had in January. And during those meeting minutes, FOMC officials, they think that policy is at a level that we can remain restrictive. And they also noted some upside risks when it comes to inflation, particularly around that tariff policy. So, Julie, more of the same here when we think about the unknown factors of trade. But everyone is looking at this very, very closely. And the anticipation, at least with this survey work, is that we're going to see greater inflation over time as a result of all of this.
Yes.
Like changes in Washington.
Most definitely, and a lot of political division even within those inflation expectations. Thanks, Allie. That's a wrap on today's Asking for a Trend. Be sure to come back Monday at 4:30 p.m. Eastern for all the latest market-moving stories affecting your wallet. Have a great night and a great